Welcome to video 5 of part 1 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss calculating tax and tax credits. Specifically, what we'll cover in this video is calculating the tax, other taxes, tax credits, and finally, tax payments. Our free resources from irs.gov, we are going to lean heavily on publication 17 and the instructions to Form 1040 as we have for the other videos in part 1. And then also we will be looking at Schedule 2 of Form 1040. And then we have these other publications here to learn more about those specific issues. As far as our flow of the tax return goes, we are going to finish it off today. We're going to handle the whole bottom half of the chart. We will talk about calculating the tax with the tax tables and tax schedules. We will be talking about tax credits. We'll be talking about other taxes. And then finally, we will be talking about the payments in order to get us down to the bottom for our amount due or our refund. So let's start with calculating the income tax. And just as a reminder, we start with our gross income. We subtract our adjustments, which leaves us with our adjusted gross income. Then we subtract our deductions, which leaves us with our taxable income. So what we're going to do now is we're going to take our taxable income and we're going to use either the tax tables or the tax rate schedules in order to determine the amount of income tax. And the tax tables will work for taxable income of less than $100,000. And then when we get to $100,000 or more, we're going to use the tax rate schedules. Now, of course, I understand that in the real world, we're going to be using tax software in order to do these computations. We're not going to be doing this by hand. However, it is important for you to understand how the software is calculating those tax amounts. And then also sometimes if you're dealing with a client, you don't have a computer close at hand, and you're just trying to do rough estimates for planning purposes, you can use these tax rate schedules or even the tax tables in order to quickly just determine what the tax should be. So it is a good idea to understand how these work. So let's start first with the tax tables. And again, the tax tables work for income up to $100,000. And this is page 1. These tables are several pages long. You can find them both in the instructions to Form 1040 and in publication 17. And so at the top here, they have an example, shows you how to use the tables. So you just look at the income. So you can see in their example there, they took taxable income, which is line 15. They said it was $25,300. So you're just going to go to the chart. You can say at least this much. So at least $25,300, but less than $25,350. The people are married filing jointly. Therefore, the amount of their tax is $2,575. That's the way you use the chart. Now you can see this is page 1. And if you look at this, let's say $2,000 of income, then you're going to look at the filing status, and it doesn't matter. No matter what the filing status is, the amount of the tax is the same. That's because we're at such low income levels here that everybody is in the same tax bracket. We'll look at the tax brackets here in a little while. But let's go to another page. This is going to actually be the last page that we have in this tax table. And here you can see it's different. So up here, let's look at this one, $99,000 to $99,050. Depending on the filing status. You can see if you're single, you would owe the $16,839. Married filing jointly would be $11,892, etc. So for whatever the level of taxable income is, line 15 of the tax return, you can use the table to determine the amount of tax. And then it reminds us here that if you've got $100,000 or more of taxable income, then you need to use the tax computation worksheet, or what I call the tax rate schedules. So let's look at those tax rate schedules now. So here you're going to pick one of these depending on filing status. So you can see single, married filing jointly, etc. So you're just going to choose whichever chart you need for the filing status. So if we look, for instance, at married filing jointly, you would come down here and you would say if they make at least $100,000, but not over $201,050, if that's their taxable income, that's what you put here. Is their taxable income. Then you're going to multiply by 22%. That's going to give you a number to put here. Then you are going to subtract $9,894, which will finally give you the tax. And that's the way all of these work. You say if the taxable income is between this number and this number, you're going to write it down here. You're going to multiply by this percentage, and these percentages correspond to the tax brackets that we will look at shortly. So then you will multiply it by that, and then you are going to subtract this amount. And I'll explain when we look at the tax brackets why we are subtracting this amount. And then that will give us the amount of our tax. So let's just do a quick example just to understand it. You've got a single taxpayer with $150,000 in taxable income. So the calculation is $150,000 times 24%. That equals $36,000. Then you are going to subtract the amount from that schedule, $6,957.50, which leaves us with a tax of $29,042.50. So if we go back to the tax rate schedule, we can see we have a single taxpayer. They've got between the 100,525 and the 191,950 times 24% minus that $6,957.50. So now these are the tax brackets for 2024. So you can look at each of these brackets, and again, based on the filing status, we can say, okay, if you've got between $0 and $11,600 of taxable income and you are single, then your tax rate is 10%. If you're married filing jointly, that goes to $23,200, etc. for each of the filing statuses. And then it just moves down. So if you're single, now if you're making $11,601 or more, up to $47,150, now you're in the 12% tax bracket, and so on and so forth. So these are the 7 tax brackets. You will want to know these for the exam: the 10%, 12%, 22, 24, 32, 35, and 37%. You will want to commit those to memory. You do not need to commit all of these tax bracket numbers to memory at all, but what you do want to do is just look through the chart, be basically familiar with it so you get a feel for where the cutoffs are, and then you'll see which tax bracket applies. So let's have a little conversation about tax brackets, because you are going to have some clients who are confused about how this works. So I want to make sure that we're all on the same page. We all understand how this works so that you can explain this to your clients about the real way that tax brackets work. So sometimes you will have people who misunderstand how they work. So let's look at this jump here from 12% to 22%. That's a very large jump. You're going up 10 percentage points in tax brackets. So let's say you have someone who is married filing jointly, and here's what the person might say to you. If they saw this chart, like if you showed them this chart, they would look at this and say, well, I would rather make $94,300. I don't want to make $94,301. I would rather stop at $94,300 than make that extra dollar. Because they say, if I make that extra dollar, that's going to put me into a higher tax bracket. And the reason they're concerned about this is because they misunderstand how tax brackets work. What they're thinking is that if they make $94,300, then all of their income is going to be taxed at 12%. But if they make $94,301, they're thinking that all of their income is going to be taxed at 22%. So they're saying, hey, I don't want to make that extra dollar because that's going to cost me an extra 10% in income tax. But that is not how tax brackets work. If you make $94,301, your first $23,200 is going to be taxed at 10%. The amount between $23,201 and $94,300 is going to be taxed at 12%. The only amount of money that is going to be taxed at 22% is that final dollar that you made. The rest of the dollars that you made are not going to be taxed at 22%. Even if you make $731,201 or more, your first $23,200 is still going to be taxed at 10%, this next amount at 12%, etc., and so forth. It does not automatically throw all of your income into the highest tax bracket. Think of the tax brackets as buckets, and your money is sitting in each bucket. All of the money in that bucket is going to be taxed at that tax rate, no matter how many buckets you have. It doesn't matter. Each bucket is taxed separately. So let me prove it to you by looking at an example. Remember this: married filing jointly, $731,201. Let's say you have that taxable income for a married filing jointly couple. Here is the calculation from those tax rate schedules. You take the $731,201, you multiply by 37%, that gives you $270,544. If our client who misunderstands tax brackets was correct, then that is the amount of tax that this couple would owe. They would owe $275.44. But we'll remember from our tax rate schedules, we're not finished yet. What we're going to do is we're going to have that subtraction amount. We are going to subtract $73,874.50, which is going to leave us finally with a tax of $196,670. So let's go back to the tax rate schedules. Let's just verify that I did that correctly. We've got married filing jointly, $731,200 over that amount times 37% minus $73,874.50. That leaves us with our tax. The reason for this subtraction amount is to take into account the fact that most of the income is not taxed at that higher tax bracket. It is adjusting for all of the income that is taxed at lower tax brackets. That's what that subtraction amount does. So that leaves us with this amount of tax. We can then compute what we call their effective tax rate. So how much tax did they pay compared to their taxable income? You just divide one by the other. That is going to leave us with 26.9%. Again, if our client who misunderstands tax brackets was correct, this should be 37%, but it's not. It's closer to 27% because those lower amounts of income were taxed at lower tax brackets. So that is how that works. So if you have a client who misunderstands that, you can gently show them how this works. If you're talking to someone at a party or something, then it's up to you whether or not you want to explain it to them. That is your choice. But at least now we all understand the correct way that the tax brackets work, and you can help to educate your clients. We do need to remember that these tax tables and tax rate schedules are only for ordinary income. As you'll remember from video 3, long-term capital gains are computed separately. So what you would do for the tax calculation is you would do the first calculation, which is all of your taxable income at the ordinary income tax rates, and then you adjust for the fact that some of that ordinary income is actually capital gain, which is taxed at a lower rate. And of course, your tax software is going to do that for you. But let's revisit those capital gains rates. This is the same exact chart we saw back in video 3. Maybe it'll make a little bit more sense now that you've seen it a second time and that you've now seen the ordinary tax rates. So here you've got your tax brackets for capital gains. There's only 3 of them: the 0, the 15, and the 20%, which of course you want to know. And then we are comparing those on this chart to the ordinary tax rates. So if you've got a single taxpayer, they make under $47,025. Any capital gains that they have are taxed at 0%, whereas any ordinary income they have is going to be at 10 or 12%, again, depending on exactly where they are within this range. And that's the way it's going to work for all of the different filing statuses. So again, remember the 3 capital gains rates, remember the 7 ordinary tax rates, and don't worry about remembering all of the exact cutoffs for the taxable income amounts. The kiddie tax. So what the kiddie tax does is it taxes unearned income, so investment income of minor children in excess of $2,600 at their parents' tax rate. So what the government is trying to prevent people from doing, especially wealthy taxpayers, is putting money, investment assets, in the name of their children in order to take advantage of their children's lower tax rates. So what they're saying is, we're going to give you $2,600 a year. If that child has $2,600 or less of investment income, then no problem. That'll just be taxed at their normal tax bracket. However, if they have more than $2,600 of investment income, that excess is going to be taxed at the parent's tax rate, to make sure that the parents aren't playing these games by moving the money around. As you'll remember, the child's standard deduction, if they can be claimed as a dependent on their parents' return, is the greater of $1,300 or their earned income plus $450. There are 2 different ways to report the kiddie tax. It depends on whether or not the child needs to file their own tax return. If they are filing their own tax return, then they will file that return and they will attach Form 8615 to compute the amount of the kiddie tax, basically to compute the amount of their income that is taxed at their parents' tax rate. If the child does not need to file their own tax return, then the parents can actually include the child's unearned income on their return, and they can do that calculation on this Form 8814. So let's look at the requirements for both of these 2 possible scenarios. First, if the child is going to file their own tax return, then what they will do is they will file that return and they will attach this Form 8615. The children who need to do this are those who meet all of the following conditions. First of all, they have more than $2,600 of unearned income. If they have $2,600 or less of unearned income, they may still be filing their own tax return, but they don't have to worry about attaching the Form 8615 or paying the kiddie tax. They don't owe it. Next, they need to be required to file their own tax return. Next, they need to either be under 18 at the end of the year or 18 but not have earned income that was more than half their support, or be a full-time student aged 19 to 24 who didn't have earned income that was more than half their support. Next, at least one of that child's parents need to be alive at the end of the year. The kiddie tax only applies to parents. If it is someone other than the parent that is claiming the child as a dependent, then there is no kiddie tax. So that's why at least one of their parents has to be alive at the end of the year. And then finally, the child doesn't file a joint tax return. If the child files a joint tax return, then there is no kiddie tax that will be applied. So let's do an example. David is 16, single, dependent of his parents, and he earned $5,000 in wages and $3,600 in dividends for gross income of $8,600. He claims a standard deduction of $5,450. Why? Because remember, it's the greater of $1,300 or his earned income plus $450. So that's $5,450. That results in taxable income of $3,150. David pays tax at his parents' tax rates on $1,000, which that is the $3,600 of his unearned income to the extent that it exceeds the $2,600 that you don't have to worry about the kiddie tax for. His remaining $2,150 of income is taxed at David's own tax rates. So again, the only amount that's taxed at the parents' rates is the amount of unearned income that exceeds $2,600. Next scenario. This is where the child is not going to file their own tax return. So they have to meet all of these conditions. The child is under age 19 or under age 24 and a full-time student. Their gross income is less than $13,000. Their only income is unearned. So it's from interest, dividends, capital gains, and these Alaska Permanent Fund dividends. The child does not file a joint return. No federal income tax was withheld from the child's income. No estimated payments were made for the child, and the taxpayer who is claiming the child is a qualifying parent. So if you meet all of these things, then you will be filling out Form 8814 in order to compute the tax on the child's income and reporting that on the parent's tax return. So it says it has to be a qualifying parent. What does that mean? Qualifying parent is one of the following. If the parents file married filing jointly, then it's easy. They're obviously the qualifying parent. If they are married filing separately, or if they're not married and they live together, so they're filing as single people, then the parent with the higher taxable income is the qualifying parent, and they have to report the income on their tax return. If the parents are living apart, they are divorced or separated, then the custodial parent is going to default to the one who includes the child's income on their tax return. If the custodial parent is remarried and filing married filing jointly, then they qualify. Or if they're filing married filing separately with their new spouse, they qualify if their taxable income is higher than their new spouse's taxable income. So that is it for the kiddie tax. Let's now move on to other taxes. So we've computed the income tax, but there can be other types of taxes. So here are those possible other taxes that will need to be paid. We are going to talk about each of these except for these two that say they are in a different video because we will cover those later. But the rest of these we are going to cover in this video. So you can see it's the alternative minimum tax, the excess advance premium tax credit, self-employment tax, the additional Medicare tax, uncollected Social Security and Medicare tax, repayment of first-time homebuyer credit, and the net investment income tax. How do we report these other taxes? Glad you asked. We put them on Schedule 2 of the Form 1040. So you can see you've got different parts where they are broken down separately. And again, we will be talking about most of these. We're not going to cover every possible other tax. We're going to be covering the ones that are likely to be tested on the exam and that are more common in practice. But this is where they are all shown. And then you finally get down to your total amount of other taxes, which then flows up to the Form 1040. So let's start with the alternative minimum tax. You will certainly get a question or two on the exam about the AMT. So the AMT is a separate additional income tax, and it is designed to make sure that taxpayers with a high economic income, but not a high taxable income, pay at least a minimum amount of tax. So what happened was back in I believe it was the 1960s, Congress got embarrassed because it came out that there were a few, and it really was just a handful, of very wealthy taxpayers who paid very little or zero income tax. And the public was outraged. So Congress went back and they created this alternative minimum tax. They wanted to make sure that the wealthy people had to pay at least something. The problem is that over time, it has now come to affect a lot more than just the super wealthy people. You can have middle income type of taxpayers who end up having to owe the alternative minimum tax just because of the way that the rules work. So we do want to be aware of this and how it works. It is reported on this Form 6251. So this is how we calculate the AMT. We always start with regular taxable income. So you first have to compute regular taxable income. Once you've done that, you are going to add what are called preference items. You are going to either add or subtract what are called adjustments. That is going to leave you with a tentative alternative minimum taxable income, or AMTI. Then you are going to subtract an exemption amount, which will leave you with your AMTI. You're going to multiply that by the AMT tax rate. You're going to subtract any AMT foreign tax credit. That will leave you with an alternative minimum tax. What you then do is you compare that to the regular income tax. And if the AMT is higher, then you have to pay the difference as an additional tax. So essentially, instead of paying the regular income tax, you will have to be paying the alternative minimum tax. So we are going to go through this calculation to explain it a little better. First of all, AMT preference items. So preferences are items that receive special treatment for regular tax purposes, and so they are added back for AMT purposes. So here are some common examples. Something called private activity bond interest, not taxable for regular tax purposes, but has to be added back for AMT. 7% of any Section 1202 gain on sale of a qualified small business stock. So you'll remember back from video 3, Section 1202, that's that stock you can sell and have up to $10 million of gain that is totally excluded from regular taxable income. So what we're saying here is if you have any of that gain, 7% of the amount that was excluded has to be added back for purposes of the AMT. And then these last two apply to oil and gas type of properties. So oil and gas depletion in excess of basis and something called intangible drilling costs differences, those are also added back. Back when the AMT came into being, some of these wealthy people who were not paying any income tax were oil magnates who were wealthy because of oil. So that's why you've got a couple of these oil and gas related preference items that have to be added back. Next are our adjustments. The difference between preferences and adjustments is that preferences are always items that are added back to regular taxable income in order to get to alternative minimum taxable income. Adjustments, on the other hand, might be added back or they might be subtracted depending on the circumstances. So the standard deduction is an adjustment. It is added back. So if the taxpayer takes the standard deduction, then that is going to be added back. If they itemize deductions, then any state, local, and foreign income, sales, and property taxes are added back. Also, if they itemize, investment interest expense is computed differently. So it can result in either more or less deductible investment interest expense. So it can be added or subtracted. Incentive stock options are taxed at the time of exercise for AMT. As you'll remember, incentive stock options usually, if they are qualified ISOs, are not taxed until the stock is actually sold. But for AMT purposes, they are taxed at the time that those options are exercised. Depreciation is computed differently for AMT, which could result in either higher or lower depreciation expense. And dispositions of property, so if you sell property, it will often result in a different gain or loss due to differences in depreciation and other items that are affecting basis. So that will be an adjustment. However, the $3,000 limit on capital losses still applies for the alternative minimum tax. Next, we will look at the exemption amount. Remember, we get to subtract an exemption amount. The purpose of the exemption is to make sure that lower income taxpayers do not have to pay any AMT. So you're going to take your tentative alternative minimum taxable income that we computed so far by taking the regular income tax, adding the preferences, and then adding or subtracting the adjustments. We're going to take that amount and we're going to subtract this exemption amount, and you can see the amounts there on your screen. You should remember these for the exam. The single and head of household are the same at the $85,700. The married filing jointly and qualifying surviving spouse is $133,300, and the married filing separately is half of the married filing jointly amount. So really what you need to remember are two numbers, 85,700 and 133,300, and then you'll know that married filing separately is half of that amount. So those are the AMT exemption amounts. However, they are phased out at higher incomes. So if you have someone with an alternative minimum taxable income of these amounts between $609,350 to $952,150, and they are single or head of household, then that exemption will phase out. So if their AMTI is less than 609,350, they will not have to phase out any of their exemption. They get the full exemption amount. If their AMTI is over $952,150, they will get no exemption whatsoever. And if their AMTI is in between those two amounts, then they will get a partial exemption. And then you can see the amounts for the other filing statuses as well. Again, I would not worry about memorizing these exact amounts. Just be familiar with them for the exam. Once we subtract those exemption amounts, we will have our final alternative minimum taxable income. And so now we will apply our AMT tax rates to that income. So you can see here for anyone other than married filing separately, these are the tax brackets. From 0 to 232,600, they pay 26%. If they have over $232,600, they pay 28%, minus this 4,652, which that is just, again, just like other tax brackets, that is adjusting for the fact that the first $232,600 is only taxed at 26%. You will want to remember for sure these tax rates. You want to know the 26 and 28% amounts. As far as these dollar amounts, I wouldn't worry too much about it, although it's not so hard to remember this one number, $232,600, and then married filing separately is half of that amount. So while you're at it, go ahead, remember those numbers in case it does come up on the exam, but definitely you want to remember the 26 and 28%. And then remember that those amounts in those brackets are the same for everybody unless you are married filing separately. So it doesn't matter what your filing status is. Up here, you're going to have the same tax brackets and tax rate amounts. And then also, this is to let you know that long-term capital gains are still taxed the same as they are for regular tax. So there is no separate AMT tax rates for long-term capital gains. So when might we know, if we're looking at a taxpayer's tax situation, when might we want to be on high alert that they might be subject to the alternative minimum tax? Well, these are the kinds of things that can cause them to have to owe the AMT. If their gross income is significantly higher than their taxable income, they may have an AMT issue. If they've got significant long-term capital gains, they may have an AMT issue. If they were exercising incentive stock options for the year, we want to look at whether or not they may owe AMT. And if they've got tax-exempt interest from these private activity bonds, then they may owe the AMT. So let's look at an example. Harold is 63. He's single. takes the standard deduction, and he has regular taxable income of $130,000. So his regular tax, if you use those tax rate schedules, is $24,243. He has tax-exempt interest from private activity bonds of $40,000. Therefore, his tentative AMT income is his $130,000 regular taxable income, plus we have to add back his standard deduction, plus we have to add back the income from those private activity bonds. So that totals $184,600. His exemption, since he's single, is $85,700, which leaves him with AMTI of $98,900. His alternative minimum tax then is 26% of that $98,900, which is $25,714. So he has to pay an additional income tax of $1,471. So we're going to compute his regular tax. Then we're going to add as an other tax on Schedule 2, $1,471 for the AMT. Credit for a prior year AMT. It is possible that you can have an AMT credit in future years. So some of the adjustments that we talked about are really just timing differences on when the expenses occur. We're not going to go into all of the details of that, and you don't need to know that. What you need to know is that you can have an AMT adjustment that results in an AMT credit in future years when the taxpayer is not subject to the alternative minimum tax. So if you've got a taxpayer who has to pay the alternative minimum tax, let's say for 2024, it might be that in 2025, they don't have to pay the alternative minimum tax. And part of the alternative minimum tax they had to pay may have been the result of one of these timing differences. So it wouldn't be fair to tax the taxpayer twice on the same income. So what they do is they allow that taxpayer a credit for that year in which they do not owe the alternative minimum tax. This credit is calculated on the Form 8801. And again, all you need to know for the exam, I know this can be confusing. All you need to know for the exam is that you can have a credit for prior year AMT. You cannot use that carryover until you have a year in which you do not owe the alternative minimum tax. That is what you need to know. Excess advance premium tax credit. We're going to talk about the premium tax credit later on in this video. But for now, we just need to know that when you buy health insurance through the government marketplace like Obamacare, depending on your income, you can get a reduced premium amount that you have to pay. That reduction is the result of a premium tax credit that you get. However, the amount of premium tax credit that you're getting is just an estimate. It's based on what you think your income is going to be for the year. When you get to the end of the year, you'll know your actual income, and then you can compute your actual amount of premium tax credit that you should have gotten. Well, if it turns out you got more premium tax credit than you should have based on your income, then you have to pay the difference back. You pay it back as an other tax. So you use this Form 8962 to figure that out. And then if you have to pay some back, that goes on to Schedule 2 as an other tax. So again, we will revisit this later in this video. Self-employment tax. We've talked about the self-employment tax before, and here it comes up again. The self-employment tax, the way you pay it is as an other tax on your Form 1040. So it's going to go on Schedule 2 as an other tax. You're going to compute it actually on Form SE. So this is based, as you'll remember, on net earnings from self-employment. So if you have net earnings from self-employment of $400 or more, and again, that is a number you're going to want to remember, then you are going to owe the self-employment tax. This could come from a Schedule C or Schedule F, could come from a K-1, from a partnership. And there are certain church employees who actually have wages and they have a W-2, but they don't have Social Security or Medicare withheld, and so they will pay the self-employment tax. As you'll remember, self-employment tax replaces Social Security and Medicare tax that you would have from a W-2 job, and it represents both the employees and the employer's share of the Social Security and Medicare tax. The rate is 15.3%. 12.4% of that is for Social Security, 2.9% of that is for Medicare. And then also, as you will remember, half of this amount is deductible as an adjustment to income. That is, the employer's share of the Social Security and Medicare is deductible as an adjustment to income. Because that amount is deductible, the net earnings from self-employment is computed by taking self-employment income, revenue minus expenses, times 92.35%. So remember, we have that $400 number that you want to remember. Well, what that means is if you have self-employment income of $434, you multiply that by 0.9235, that leaves you with $400 of net earnings from self-employment, and you have to pay the self-employment tax. So essentially, if you have self-employment income before applying this 92.35% of $434 or more, that will leave you with $400 or more of net earnings from self-employment, and you will have to pay the SE tax. So let's look at an example. Leo has a Schedule C business with $60,000 of revenue and $23,000 of expenses, so his profit is $37,000. His net earnings from self-employment is that $37,000 times 0.9235, which is $34,170. So he will owe self-employment tax of $34,170 times 15.3%, which is $5,228. Just like Social Security or FICA withholding from a paycheck, only the first $168,600 of self-employment income is subject to the 12.4% portion of the self-employment tax. So if you've got a job with a salary, only $168,600 of that is subject to Social Security tax. So it's the same exact thing then if you are self-employed, only that amount of self-employment income is going to be subject to the 12.4% portion of the self-employment tax. But all of your self-employment income is subject to the 2.9% Medicare tax, just like all of your wages are subject to the 2.9% Medicare tax. So that same rule applies whether you have a salary or whether you have self-employment income. The self-employment tax optional methods. So some taxpayers that have a loss from their business or they have a very small amount of income, they are allowed to use an optional method and to actually pay self-employment tax. So normally, if you have a loss, you wouldn't have any self-employment tax. And if you had a very small amount of income, you'd have little or no self-employment tax. But some people actually want to pay self-employment tax. You say, why would they want to do that? Well, a couple of different reasons. First of all, the way Social Security works is the amount of your earnings are tracked each year and the amount that you pay in to Social Security. And then you get credit for all of those amounts toward your retirement. So when you retire, there's a calculation that's done that's going to look back in your whole working life to determine how much your monthly Social Security benefit is. So if you have a year or a lot of years, especially with little or no earned income, your Social Security check that you get in retirement is going to be less than it otherwise might be. So what this optional method does is it allows self-employed people to use for purposes of self-employment tax and Social Security, instead of using their net earnings from self-employment. Instead, they use 2/3 of their gross income from their business. They use that number to determine their earned income and to pay self-employment tax on that. This can also be used by people who may be entitled to certain credits. So we're going to be talking about credits later in this video. Some of those credits depend on the amount of your earned income. And so if you don't have any earned income, you're not entitled to that credit. And so again, those people might want to use this optional method as well. So it's only for self-employed people, but it allows them to report some earned income and to pay some self-employment tax for these reasons. Additional Medicare tax. Now, this applies not just to self-employed people, but even to people that have a job with a salary. Certain high-income taxpayers must pay an additional 0.9% of their income for Medicare in addition to the regular 2.9% that everyone pays. So remember, we said no matter how much salary or self-employment income you have to pay in 2.9% of your income into Medicare. Actually, if you have a salary, you're paying 1.45% and your employer is paying 1.45%. But the government, the Medicare system, is getting 2.9%. If you are self-employed, then you are paying in the entire 2.9%. But in any case, if you are a quote unquote high income taxpayer, you have to pay in an additional 0.9%. And this comes all from the employee, does not come from the employer. So it is an other tax that you're going to show on your Form 1040. Who is subject to this? Well, if you have wages or self-employment income over these threshold amounts, then you have to pay this 0.9%. So if you are single, head of household, or qualifying surviving spouse, if your earned income is over $200,000, then you have to pay the extra 0.9%. If you're married filing jointly, it's $250,000. If you're married filing separately, it's half of that amount, or $125,000. This is not a phase in or phase out. This is a threshold amount. Either you have over $200,000 or you don't. If you have over $200,000, you pay the 0.9%. If you don't have over $200,000, you don't pay the 0.9%. Of course, that's for the people in these filing statuses. So these are threshold amounts, not phase out amounts. Our next other tax, uncollected Social Security and Medicare tax. So if you get tips, you're supposed to report those. If for some reason you did not report those, then you're still supposed to pay Social Security and Medicare tax. And so you do that using this Form 4137, and you report that on your Form 1040. Not very common. I'm not saying that people who get these tips are actually going to report this, but this is the rule. They are supposed to report those and pay the extra Social Security and Medicare tax on those amounts. First-time home buyer credit repayment. So back in 2008, during the housing crisis, there was a credit given to people who bought a home. It was to encourage people to buy homes. However, it's a credit that they actually had to pay back. So they got the credit in 2008, but then they have to pay the credit back from 2010 through 2025. So for 2024, you could still have people who are paying this back. If they do so, they use this Form 5405 and they report that as an other tax. The net investment income tax. So certain high income taxpayers must pay an additional 3.8% tax on their net investment income. Investment income, as we've seen before, includes interest, dividends, capital gains, rents, royalties, etc. Net investment income means you get to actually subtract investment expenses. So you take their gross investment income, you subtract their investment expenses that were incurred to produce that income. That's your net investment income. They have to pay 3.8% tax on that net investment income. But again, this only applies to quote unquote high income taxpayers. And these are going to look familiar. The amounts are the same that we saw before when we were talking about the additional Medicare tax. Do note, however, that the chart is a little bit different. The amounts are the same, but the filing statuses are different. So for the net investment income tax, if you are single or head of household, you use the $200,000 amount. And again, it's a threshold amount, not a phase out amount. If you are married filing jointly or qualifying surviving spouse, you use $250,000. In the other chart for the additional Medicare tax, qualifying surviving spouse is actually up here with single and head of household. So it's $200,000. For the net investment income tax, qualifying surviving spouse is on an equal level with married filing jointly at $250,000, and then married filing separately is half that amount at $125,000. So it'd probably be good to remember these amounts because it does apply to both of these types of taxes. Now, very importantly, the amount of net investment income that is subject to this extra 3.8% tax is the lesser of the net investment income or the amount that the modified adjusted gross income exceeds the threshold amount. So let's do an example so we can look at this. Veronica and Vince live and work in the United States, and they file married filing jointly. Their adjusted gross income is $275,000, and they have net investment income of $40,000. They must pay an additional 3.8% tax on $25,000. Now, why is it only $25,000 when they've got $40,000 of net investment income? Well, they are married filing jointly, so their threshold amount is $250,000. Their adjusted gross income is $275,000. So they only exceeded the threshold amount by $25,000. So that is the amount. It's the lesser of the amount they exceed the threshold by or their net investment income. So it's the lesser of $25,000 or $40,000. So they owe that 3.8% on the $25,000. So their additional tax is $950. That is it for other income. Let's talk now about tax credits. There are many different tax credits that the taxpayer may have. These are the major ones and the ones that we are going to talk about in this video. But before we do that, we need to understand what a tax credit is and compare it to a tax deduction. So a tax credit is a dollar for dollar reduction in the amount of tax owed. So for example, you do your calculation, you compute your tax, and you owe $3,000. If you have a $1,000 tax credit, your tax due is now $2,000. So it's a dollar for dollar reduction. You have a $1,000 tax credit that lowers your tax bill by $1,000. A tax deduction, on the other hand, reduces the amount of income that is subject to tax. So it indirectly lowers your tax, but it is not dollar for dollar. So for example, if you've got someone that's married filing jointly and their taxable income is $20,000, that's going to result in a tax of $2,000 because remember, at those lower income amounts, it's a 10% tax bracket. So if they had a $1,000 tax deduction, their taxable income would now be $19,000 and their resulting tax would be $1,900. So they would owe less tax, but it's only $100 less. It's 10% of that $1,000 because they're in the 10% tax bracket. So because of this difference, tax credits are usually preferred over tax deductions. Tax credits are dollar for dollar. Tax deduction is just an indirect lowering of the amount of tax due, but it is not dollar for dollar. When we are talking about tax credits, there are some tax credits that are refundable, other tax credits that are non-refundable. So what does that mean? Well, again, we normally think of a tax credit. If you owe $3,000, you have a $1,000 credit. Now you only owe $2,000, dollar for dollar reduction. That's great. But what if you only owe, let's say, $600 and you've got a $1,000 tax credit? What happens then? Well, if you have a refundable tax credit, then first of all, you're not going to owe that $600. That is gone. But in addition to that, the government is actually going to send you a check for $400. That credit is refundable, which means you will actually get a refund of the difference between the amount of tax that you owed and the amount of the refundable tax credit. If that credit were non-refundable, you still would not owe the $600. The $600 would still be reduced to zero. However, nobody is sending you a check for $400. You've just lost out on that extra $400. So that is the difference between refundable and non-refundable. And you are going to see that as a theme as we go through these credits. Some of them are refundable, some of them are not refundable. So let's talk about our first tax credit, the child tax credit. So this is $2,000 for each child under age 17 at the end of the year. So again, we look at their age, end of the year. If they are under 17, then it is a $2,000 credit. This is a non-refundable credit technically. However, we're going to be talking next about this additional child tax credit, which can actually make much of this refundable. But the actual $2,000 child tax credit is technically non-refundable. There is also a phase out for this. So the credit is going to be reduced by $50 for each $1,000 of modified adjusted gross income above $400,000 for married filing jointly and $200,000 for everybody else. The enhanced credit that we had back in 2021 no longer applies. So you may remember when this $2,000 was a much larger figure, but that no longer applies because remember, we're talking about the 2024 tax year. So this credit is for anyone who is a qualifying child. So what do we mean by a qualifying child? This is going to be similar to other qualifications that we've seen. They have to be a child, son, daughter, stepchild, etc., or they could be a brother or sister or a descendant of any of them, such as a grandchild, niece, nephew, etc. They again have to be under age 17 at the end of the year. They don't provide more than half of their own support. They lived with you for more than half the year. They are claimed as a dependent on your tax return. So remember when we were talking about who gets the dependent, the main thing that does is allows that person to claim the child tax credit. Having the dependent allows the child tax credit. The child cannot file married filing jointly, or if they do, the only reason they do is to get a refund of amounts withheld. The child must be a U.S. citizen, a U.S. national, or a U.S. resident alien, and they must have a Social Security number. So if they meet all of this criteria, then they are a qualifying child for that $2,000 child tax credit. Now let's talk about the additional child tax credit. So what this does is it makes $1,700 of the $2,000 child tax credit refundable. It applies to taxpayers whose child tax credit is greater than the amount of tax they owe, which makes sense. If the amount of tax they owed was more than the child tax credit, then we wouldn't worry about whether or not it was refundable because they would be getting the entire $2,000. So this is only going to apply to people whose tax that they owe is less than the $2,000. In order to qualify for this, they must have at least $2,500 of earned income or 3 or more qualifying dependents. So they can have either of those things. If they don't have 3 or more qualifying dependents, they have to have at least $2,500 of earned income. If they don't have $2,500 of earned income, then they have to have 3 or more qualifying dependents in order to qualify for this additional child tax credit. And this is not allowed if they file this Form 2555 to exclude foreign earned income. Credit for other dependents. And yes, ODC is the correct acronym because it's sometimes called the Other Dependents Credit. So you can call it either one that you want. The child tax credit, as you will recall, is limited to those under 17 and who meet those other tests. The credit for other dependents is available for a wider range of dependents, including children who are over the age of 17, but the maximum credit is only $500. So instead of being $2,000, it is $500. In order to qualify for this, a qualifying person has to be claimed as a dependent on your tax return, just like with the child tax credit. It cannot be used if you do claim the child tax credit for that child. So you can't claim the same person for both the child tax credit and the credit for other dependents. The person has to be, again, a U.S. citizen, national, or a resident alien, and they have to have a Social Security number or an ITIN or an ATIN. This also is phased out, just like the child tax credit. It's reduced by $50 for each $1,000 of adjusted gross income over those same amounts. $400,000 married family jointly, $200,000 for everyone else. Moving on to our next credit. This is the Child and Dependent Care Credit. This is a non-refundable credit for expenses paid for the care of a child or other qualifying person while you worked or looked for work. So if you've got a child or other qualifying person, you are paying childcare, let's say for them, let's say it's a child, you're paying childcare expenses for them. You can get a credit for those expenses that are paid. However, it's only if you're paying those expenses in order to work or to look for work. This is not so that you can go play tennis. This is not even for you to go to school. That doesn't count. It has to be for you to work or to look for work. You can claim the credit on up to $3,000 of eligible expenses for one qualifying person and up to $6,000 for two or more. So it is $3,000 per eligible person. However, it is a maximum of $6,000 or more. So if you've got three or more qualifying children or other persons, your maximum is still going to be $6,000 of expenses that you can use to claim the credit. And the credit itself is 20 to 35% of those eligible expenses. And the amount of that credit is going to depend on your adjusted gross income. You don't need to know where the cutoffs are for the different percentages. Just know that it is 20% to 35%, and it is on expenses of $3,000 per eligible person up to a total maximum of $6,000. And this is computed on Form 2441. So who is a qualifying person for this credit? First of all, it could be a child. So a qualifying child under age 13 who you can claim as a dependent. If the child turned 13 during the year, the child qualifies for the part of the year before they turned 13. So this is kind of unique in the tax law. Usually when we're talking about someone's age, we look at their age at the end of the year. But for this, you get to look at when they turned 13. So for the part of the year that they were 12, you can still take the child independent care credit. But then for the part of the year after they turn 13, you cannot take the credit. Other qualifying people, a qualifying person could be your disabled spouse who was not physically or mentally capable to care for themselves and they lived with you for more than half the year. Or it could be any disabled person if they lived with you for more than half the year and you can claim them as a dependent. If that person is your spouse, you don't have to be able to claim them as a dependent. If it is anybody other than your spouse, then you have to be able to claim them as a dependent, or you could have claimed them as a dependent, except that they met one of these exceptions that we have seen before. So for the exam, just remember this. There's three categories of people that are qualifying persons: children under age 13, a disabled spouse, and any other disabled person if they can be claimed as a dependent and they lived with you for more than half the year. Reminder that this is a credit for dependent care expenses paid so you could work or look for work. Child support payments do not qualify, so you can't say, well, I'm paying my former spouse child support to care for our child. That does not work. Child support payments are never deductible, so you can't call those child support payments dependent care and get this credit for them. And any amounts that are reimbursed by a social service agencies do not qualify. So this has to be unreimbursed expenses that you have for the child care in order to qualify. This can include, it's not just like babysitting. It can include household services need to care for the person, such as services of a maid, a cook, a babysitter, a cleaning person, etc., but not a chauffeur, a bartender, or a gardener. In order to qualify for this credit, this is what the taxpayer has to have. So we talked about qualifying children and qualifying dependents, but this is who qualifies to actually take the credit. They can have any filing status except married filing separately, but there's some exceptions even to that. The care had to be provided so you could work or look for work. I think that's the third time we've said it has to be so you can work or look for work. That's probably important for the exam. The care was for one or more qualifying persons. The person who provided the care was not your spouse, the parent of the qualifying child, or a person that you can claim as a dependent. So you can't pay your spouse to care for your child and then take the child independent care credit for that. You cannot pay your 17-year-old child to care for the younger child, for instance, and take the credit for that. If it was your child, they have to have been at least 19 years old and they cannot be claimed as your dependent. So if they are under 19 and or they can be claimed as your dependent and they are your child, then you cannot take this credit for amounts that you paid them to provide the care. And then you must report required information about the care provider on this Form 2441. So you have to let the IRS know the name, their address, their social security number, and the amount you paid, because the IRS wants to make sure that that person is reporting the income on their tax return. As we said, married filing separately usually does not qualify. However, they can qualify if they meet this criteria that you lived apart from your spouse for the last 6 months of the year. Your home was the qualifying person's main home for more than 6 months of the year, and you paid more than half the cost of keeping up that home. Our next credit is the Earned Income Credit, or EIC. This quotation is straight from publication 596. Here's what it says. The EIC is a tax credit for certain people who work and have earned income under $66,819. A tax credit usually means more money in your pocket. It reduces the amount of tax you owe. The EIC may also give you a refund. So that is a clue here that the EIC is a refundable credit. So first, we're going to talk about the rules for everyone. So there used to be a time when the earned income credit was only available to taxpayers who had children. If you didn't have a child, you could not get the earned income credit. That is different now. It is possible to get the EIC even if you don't have children. So there are rules that we're going to go over. Some of those rules apply to everyone, whether you have children or not. Some of those rules only apply if you have children. Some of those rules only apply if you do not have children. So first, we're going to talk about the rules that apply to everyone, whether you have children or not. And we'll talk about each of these things in turn, but there are certain adjusted gross income limits that you have. You have to have a valid social security number. If you're married filing separately, there are special rules. You have to be a U.S. citizen or resident alien. You cannot have filed this Form 2555 to exclude foreign earned income. Your investment income must be less than $11,600, and you must have some earned income. So let's look at each of these. First of all, the adjusted gross income limits. So both your adjusted gross income and your earned income must be less than the amounts shown here on the slide. So if you're not married filing jointly and you have 3 or more qualifying children, then your adjusted gross income cannot be more than $59,899. If you are married filing jointly, that amount is $66,819. And then you can see the amounts for the other filing statuses. Do not worry about memorizing these numbers, but just understand how this works. The more qualifying children you have, the higher these dollar amounts are. The fewer qualifying children, of course, the lower these dollar amounts are for your adjusted gross income. Special rules if you are married filing separately. Usually, you have to file married filing jointly in order to claim the EIC. However, if you meet certain criteria and you're married filing separately, then you can still take it. You had to have a qualifying child who lived with you for more than half the year, and either you lived apart from your spouse for the last 6 months of the year, or you are legally separated and did not live in the same household as your spouse at the end of the year. So remember the general rule, you have to be married filing jointly, but if you meet this criteria, you can take the EIC even if you are filing separately. Next rule, you have to have a valid Social Security number. You have to have it. If you're married filing jointly, your spouse has to have a valid Social Security number, and the children have to have a valid Social Security number. You must be a U.S. citizen or resident alien for the entire year, unless you meet that exception we talked about before, where a non resident alien can elect to be taxed as a resident alien and file jointly with their spouse. You cannot have filed the Form 2555, excluding foreign earned income, and your investment income must be $11,600 or less. And investment income is all the things that we have talked about before. The idea here is that the earned income credit is supposed to be for low earning taxpayers and taxpayers who don't have a lot of money. So if you've got investment income of $11,600 or more, you must have some money somewhere stashed away in order to be earning that investment income. So what the government is saying here is if you've got more than $11,600 of investment income, then we are not going to allow you to take the earned income credit. Next, you do have to have earned income. It's called, after all, the earned income credit. So earned income is what you would expect, wages and net earnings from self-employment. Those are going to be the main categories for most people. And you can see here on the slide, there are other things that count as well. But the main thing to remember is that you do have to have earned income in order to qualify for this. Now we're going to move to the rules if you do have a qualifying child. So you have to meet all those rules we just talked about, the rules for everyone. And if you have a qualifying child, you have to meet these rules. Your child must meet the relationship, age, residency, and joint return tests. The qualifying child cannot be used by more than one person to claim the EIC. And you cannot be the qualifying child of another taxpayer if you are claiming the EIC. So if you want to claim the EIC for a qualifying child, you cannot be claimed as a qualifying child on someone else's tax return. So first, you have to meet the relationship, age, residency, and joint return tests. So this is going to look familiar. This is very similar to what we saw for a qualifying child for the being a dependent in video 1. They have to meet the relationship test, son or daughter, brother or sister, or descendant of any of them. They have to be under age 19 and younger than you, or they have to be under age 24 at the end of the year and a full-time student and younger than you, or they have to be permanently and totally disabled regardless of what their age is. Next, residency. The child must have lived with you in the United States for more than half the year. However, it does not have to be a traditional home. So, for example, you could be in a homeless shelter, but as long as you're living together, it counts. And then there are the exceptions for birth or death during the year, temporary absences that we have seen previously. Joint return. The child cannot have filed a joint return for the year unless it was just to get a refund of amounts paid in. Any married child has to be your dependent in order to qualify for the earned income credit. So if they're not married, they don't necessarily have to be your dependent. But if they are married, then they do have to be your dependent, or they could have been your dependent except that their other parent claimed them on their tax return. The qualifying child cannot be used by more than one person to claim the EIC. So this is just like other rules that we've looked at. You can't have one person claimed as a dependent on more than one other person's tax return. You cannot have one person claimed for the EIC by more than one person. If there is a dispute, we have those tiebreaker rules. They're the exact same tiebreaker rules that we looked at in video 1. We will refresh your memory here on the next slide. But then the final qualification is, again, you cannot be the qualifying child of another taxpayer and take the EIC. So here are those tiebreaker rules, exact same slide that you saw in video 1. If only one person who wants to take the EIC is the child's parent, then the parent wins. If both parents try to claim the child for the EIC, then it goes to the one that the child lived with for more than half the year. If the child lived with each parent equally, then it's the parent with the higher AGI who gets to take the EIC. If neither parent can treat the child as a qualifying child, then the person with the highest AGI wins. And if no parent claims the child, then it goes to the person with the highest AGI, as long as their AGI is higher than any of the parents who could claim the child. You'll remember that exception from video 1. Now we're going to talk about the rules if you do not have a qualifying child. So again, you have to meet all the rules that apply to everyone. And in addition to that, if you do not have a qualifying child, then you have to meet these age requirements. Remember, there's no age requirements if you have a qualifying child. But if you don't have a qualifying child, you have to be at least 25, but under age 65 at the end of the year. And if you are married filing jointly, either spouse can qualify. But you have to be at least 25, but under 65. You will want to remember that for the exam. You cannot be the dependent of another person. You cannot be a qualifying child of another person, and you must have lived in the United States for more than half the year. So that's it for the earned income credit. So now let's move on to the education credits. There are two types of education credits. There's the American Opportunity Credit, or AOC, and the Lifetime Learning Credit, or LLC. The AOC is usually going to be best for undergraduates, and the LLC is usually going to be best for graduate school and ongoing education after your first 4 years. The credits, either of these credits, can be taken by the student if the student is not a dependent on someone else's tax return. If they are, then the credit can be taken by the person who is claiming that student as a dependent, such as their parent. But you cannot take both credits for the same student in the same year. Both of these credits do phase out. So if you are not married filing jointly, if you have less than $80,000 of modified adjusted gross income, you are entitled to the full credit. If you have more than $90,000 of modified adjusted gross income, you do not get any of the education credit. And if you've got between $80,000 and $90,000, you get a partial credit. And then those adjusted gross income amounts double if you are married filing jointly. And then for this purpose, modified adjusted gross income, for most people, it's going to be the same as adjusted gross income. But then again, you're going to add back foreign income or Puerto Rican income that was excluded. For these credits, either of these credits, you cannot file married filing separately. And this is one of the few places where there are no exceptions. If you are married filing separately, you cannot take the education credits, period. The expenses will be deemed to be paid by the person claiming the credit. So remember, we said if the student could not be claimed as a dependent on anybody else's return, they could take the credit. But they don't actually have to have paid the expenses. So the parent may have paid the expenses, but the child is not claimed as a dependent on the parent's return. The child can still take the credit, even though they did not themselves pay the expenses. And of course, it can work the other way around too. If the student paid the expenses, but they are a dependent on their parents' return, the parents can take the credit. And this must be for education at a accredited post-secondary education institution. So now let's talk about each of the individual credits. Those rules we just talked about applied to both credits. But for the American Opportunity Credit in particular, the amount of the credit is up to $2,500 per qualifying student. So you get 100% of the first $2,000 of education expenses, and you get 25% of the next $2,000 of education expenses up to that maximum of $2,500. Up to 40% or a maximum of $1,000 is refundable. So the whole 2,500 is not refundable, but 40% of it is refundable up to that $1,000 maximum. However, it is not refundable for a full-time student under age 24 who earns less than half the amount of their support. They're living with their parent, yet they are not claimed as a dependent by someone else. So they don't want people playing games and saying, okay, we're not going to claim you as a dependent. So therefore, you can take the American Opportunity Credit, and for you, it will be refundable. They're not doing that. If the person is under 24, they're a full-time student, they could be claimed as a dependent by the parent, but they're not being claimed as a dependent by the parent, then none of this AOC is refundable. But for most people, 40% is refundable. Student qualifications. So in order to qualify for the AOC, the student has to meet all of these things. First of all, they have not completed 4 years of college. So this is for freshman through senior years of college. The AOC has not previously been claimed for this student for a total of 4 years. So if it's been claimed for 3 years or less, then you can claim it again. For at least one academic period, for example, a semester, the student was enrolled at least half-time in a program that leads to a degree or a certificate. The student has never been convicted of a felony for possession or distribution of a controlled substance. Whoever is filing for the return and the student have to have a Social Security number or a TIN. You have to have received a 1098-T from the school, and you have to provide the school's employer identification number on the Form 8863 that you fill out in order to get the credit. So what expenses qualify as education expenses? So it's going to be tuition and fees, first of all. It does not matter if those are paid by cash, by check, by credit card, or if you got a student loan and paid for them. Doesn't matter. They do qualify. It also is going to include other course materials that you need to get for your courses. So books, supplies, etc. Those also qualify for the AOC. And it does include non-academic fees if those are not voluntary. So sometimes you've got a student activity fee or an athletic fee, and you have to pay those in order to get into the school. If that's the case, then you can include those as well. So for the AOC, it's tuition and fees, books, and other materials that you need, and any non-voluntary fees that you have to pay. Non-qualified expenses. So fees for personal expenses are never going to be qualified. So that includes room and board. It includes insurance, includes medical expenses, transportation. You have to live somewhere and you have to eat, and you need medical insurance whether you are a full-time student or not. So those things, even room and board, do not count as qualified education expenses. Also, any fees for any course involving sports, games, or hobbies, or any non-credit course are not allowed unless they are a part of the student's degree program. Lifetime learning credit, so this is that other credit. This credit is 20% of qualified expenses up to a maximum of $2,000. You can claim this on multiple students, but it is still $2,000 maximum in total, no matter how many students you have. But there is no limit on the number of years that you can take this credit. And if you've got one of those felony drug convictions, then you are not prohibited from taking the credit. Qualified expenses, this is going to be similar to what we saw for the other credit, but not exactly the same. So the first part is the same, tuition and fees, no matter how they were paid. The books and supplies is a little bit different. You can only count amounts paid for books, supplies, and equipment if they were required to be paid to the institution as a condition of enrollment or attendance. So you had to have paid those amounts actually to the college or the technical school or whatever that you're going to. And those were required to be purchased in order to take the classes. And then you've got those non-academic fees again, and that is the same as with the AOC. Non-qualified expenses for the LLC. Very much the same as with the AOC, one little bit different in the second bullet point. First bullet point, exactly the same. Personal expenses, room and board, those are not qualified expenses. And then the fees for any course or activity involving sports, games, or hobbies, they're not allowed unless it's part of the student's degree program or it helps the student acquire or improve job skills. So that's a little bit different. That last phrase there is different than we saw with the AOC. For both the AOC and the LLC, the qualified expenses are reduced by any tax-free educational assistance that was received, such as scholarships, fellowships, or employer-provided educational assistance, veterans educational assistance. So you can only use unreimbursed expenses that you actually paid out of pocket for these. So if you got a scholarship, that doesn't count. If your employer reimbursed you for the amounts paid, those expenses don't count. But any expenses you had in addition to those amounts do still count for the credits. Next is a couple of charts. This is just overviews of what we just talked about. So these are actually from publication 970 that talks about these credits. And it just gives you in a table, this first one is for the American Opportunity Credit. It shows you all the requirements in kind of a compact form. And then the next slide is the same type of chart for the Lifetime Learning Credit. So just wanted you to know that those exist. It might be an easier way to study to have everything in one place. Moving on to adoption credits. You can get a credit for qualified adoption expenses for adopting a qualified U.S. or foreign child. The child must be either under age 18 or disabled. The credit is allowed for up to $16,810 of expenses per child. The credit does phase out for modified adjusted gross income between $252,150 and $292,150. This is generally not available for married filing separately, though there are exceptions. And you're going to use Form 8839 to figure this credit, so you can see that form and its instructions to get details. For U.S. adoptions, qualified expenses can be taken in the year after they were incurred, even if the adoption is not finalized yet, and even if it never becomes final. So if you are at least attempting to adopt a U.S. child, then even if the adoption never becomes final, you can still take the credit. For foreign child adoptions, the qualified expenses, no matter when they were incurred, can be taken in the year the adoption becomes final. So these are some exceptions to our cash basis of accounting. Here, when you paid those expenses, it's not what is important. It's not even when they were incurred in this case. It's that all of the expenses that qualify can be taken in the year that the adoption becomes final. And notice that for a foreign child, the adoption does have to become final, whereas with a U.S. child, it does not. For any qualifying adoption, qualified expenses paid during or after the year of adoption is finalized are allowable in the year of payment. So you may have expenses even after the adoption is finalized. That's fine. You can go ahead and take the credit for those amounts that were paid. However, all of the expenses over all of the years are still going to be subject to that $16,810 limit per child in total. And the adoption credit is non-refundable. However, the excess can be carried forward for up to 5 years. So it's not refundable in the current year, but if you've got extra, then you can use that for up to 5 years in the future. In addition to the adoption credit, if you received adoption benefits from your employer, then you can exclude up to $16,810 of those benefits. So some employers do offer adoption assistance. You can exclude that amount up to the $16,810. If you still have even more expenses above the amounts that were reimbursed by your employer, then you can take the credit for that as well. So you could take a credit for up to another $16,810 of expenses. Moving on to the premium tax credit. We referred to this earlier when we were talking about other taxes. So this is a credit for certain people who are enrolled in a qualified health plan through the ACA, the Affordable Care Act, sometimes known as Obamacare. So you get your health insurance through this marketplace. It is a refundable credit, and the purpose of it is to help you pay for those premiums for your health insurance. The taxpayer should receive a Form 1095-A to help compute the credit, and you compute it on the Form 8962. In order to qualify for this credit, you generally must earn at least 100% of the federal poverty level. Why is that rule there? Well, if you earn less than 100% of the federal poverty level, you should be qualified for Medicaid. So if you can get Medicaid, then you need to get Medicaid. You are not going to be eligible for the premium tax credit. You also cannot have access to insurance through an employer. So whether or not you take advantage of it is not the issue. If you have access to insurance through your employer or your spouse's employer, then you cannot take the premium tax credit. You cannot be eligible for Medicare, Medicaid, TRICARE, or other government type of health insurance. TRICARE is for members of the military. You must be enrolled in and paying toward a marketplace ACA plan. You must file a tax return. So back in video 1, when we talked about people who have to file a return, regardless of the amount of their gross income, this was one of those exceptions. If you're taking the premium tax credit, you do have to file a tax return, and you are generally not allowed to file married filing separately. You can get, as we talked about when we talked about other taxes, advance payments toward the credit to correspond with your premium payments. So the insurer will just reduce your monthly premium for the estimated amount of the credit. But then, as we said, at the end of the year, you have to reconcile the two. You have to reconcile what the estimated credit was with the actual amount of credit that you were due based on what your actual income turned out to be. You do that reconciliation on the Form 8962. And if you have to pay some of it back, that gets counted as an other tax. And then just the way this works is the higher your income, the lower your premium tax credit. So this is to help people pay for their health insurance. So the more money you make, the less help they are going to give you. Next, we're going to talk about the energy credits. There are both residential energy credits and vehicle energy credits. They are all non-refundable, although we will see there's a little bit of a difference with one of the credits. But the residential credits, we'll talk about these. It's the Energy Efficient Home Improvement Credit and the Residential Clean Energy Credit. And then for the vehicles, you can get a credit potentially for a new electric or hybrid vehicle or for a pre-owned electric or hybrid vehicle. So the Energy Efficient Home Improvement Credit, this is for exterior doors, windows, skylights, and insulation materials, central air conditioners, water heaters, furnaces, etc., biomass stoves and boilers, home energy audits. So you can actually get a credit for paying someone to come in and look at your house and give you tips on how you can save energy. All of these things do have to meet certain standards. The credit is 30% of the cost of all of these things up to a maximum of $1,200. If you're talking about windows, the limit is $600 in total for windows. For doors, it is $250 per door up to a maximum of $500. If you have central air conditioner or certain hot water heaters, the maximum is $600 per item. And if you get one of those home energy audits, the maximum is $150. If you get certain types of heat pumps, biomass stoves, and boilers, they can have an annual credit limit of $2,000 rather than the $600 for other air conditioner type of items. There is no lifetime limit. So you have these annual limits, that $1,200 annual limit, but there's no lifetime limit. There used to be, but they don't have that anymore. This is non-refundable and it cannot be carried over to future years. The residential clean energy credit, this is for solar, wind, geothermal power, includes solar water heaters, fuel cells, battery storage. The credit, again, is 30% of the cost. However, there is no limit. So there's no annual limit, there's no lifetime limit, and it is non-refundable. But for this credit, this is the only energy credit that this applies to, the excess credit can be carried over to future years. For new electric and hybrid vehicles, you can get a credit of up to $7,500. The availability of the credit is going to depend on various factors. The dealer will know, because you're always going to be buying these through a dealer, they will know whether or not it qualifies. And there are also some adjusted gross income limitations that we will talk about. The list price of the vehicle cannot exceed $80,000 for vans or SUVs or pickups, or $55,000 for other vehicles. So very often, if you go to buy one of these, you're going to see that the MSRP is exactly $80,000 or exactly $55,000. And this is the reason for that. It's so that the people who are buying it can take advantage of this credit. It is non-refundable and cannot be carried over to future years. So previously owned or used electric or hybrid vehicles, they can get a credit for up to 30% of the sales price of the vehicle up to a maximum of $4,000 credit. This is available once every 3 years, so you can't do it more often than that. Again, the credit is going to depend on various factors, and you still have the adjusted gross income limits that we will talk about. These must be bought from a dealer. So if you're buying the car just from a private individual, you cannot get this credit. So it has to be from a dealer, and it has to be at least 2 model years old. So for 2024 tax returns, it has to be a model 2022 or 2021 or earlier vehicle. The sales price for a used vehicle cannot exceed $25,000, and the credit is non-refundable and cannot be carried over to future years. The adjusted gross income thresholds that we talked about. Again, this is a threshold, not a phase out. So if you are married filing jointly or qualifying surviving spouse, if your adjusted gross income is under $300,000, you can take the credit for a new vehicle. If it is over $300,000, you cannot take the credit. There is no phase out. And then you can see the other amounts. Head of household is $225,000, and then single or married filing separately is half of the married filing jointly amount, or $150,000. For used vehicles, you cut those amounts in half. So married filing jointly is $150,000, head of household $112,500, single married filing separately is $75,000. You can also use your adjusted gross income from the previous year if it was lower than the current year. So you can use either current year adjusted gross income or previous year adjusted gross income in order to meet these threshold amounts. This is new for 2024. If you have either a new or used clean vehicle credit, if you purchased that vehicle from a dealer, which of course you had to have purchased it from a dealer in order to get the credit, and they reduced the amount that you paid for the car by transferring the credit to the dealer, then you have to meet these criteria. First of all, you have to file a tax return, even if you don't meet the normal gross income requirements. And you have to attach this Form 8936 to the return. So, what usually happens when you get the credit is you buy the car. Let's say it's a new car, you pay $80,000 for it. Then at the end of the year, you file your tax return and you get a $7,500 credit on your taxes. What they can do is they can just say, okay, instead of selling you the car for $80,000, we will sell it to you for, what would that be? $72,500. So we're going to subtract the $7,500 from the $80,000. We'll just sell it to you for $72,500. And then we, the dealer, will take the credit. So you're just transferring the credit from the one buying the car to the car dealer. This allows the person buying the car to get the benefit of the credit earlier rather than having to wait to file their tax return. But if they do that, they have to file a return and they have to file this Form 8936. Moving on to our next credit is the Retirement Savings Contribution Credit. This is a credit for low and middle income taxpayers to encourage them to make voluntary contributions to retirement savings accounts. The credit can be 10, 20, or 50% of the amount contributed, depending on income. This is only allowed for people with adjusted gross income under the amounts shown on your screen. So $38,250 if you're single, married filing separately, or qualifying surviving spouse. Double that amount if you are married filing jointly. And in between those two amounts, $57,375 if you are head of household. And this credit is non-refundable. Credit for the elderly or disabled. You can get this credit if you are either 65 or older or disabled and you meet certain income limits. And for this purpose, disabled means you were permanently and totally disabled before you retired and you receive taxable disability income and you are younger than your employer's mandatory retirement age. So if you meet all of those things, you are considered disabled and you are eligible for this credit. Or if you are age 65 or older, you are eligible for this credit. You do this on Schedule R. You can actually check a box and the IRS will compute the credit for you. The credit is non-refundable and it is usually very small. It's usually going to be less than $200, but it can be nice for those lower income taxpayers because their adjusted gross income, in order to qualify for this credit, cannot exceed the amount you see on your screen. In addition, their non-taxable Social Security, pension, and annuity and disability income cannot exceed these amounts that you see on your screen. So you have to meet both of these tests. Your adjusted gross income cannot be more than these amounts, and that non-taxable income cannot be more than the amounts shown on the bottom half of that slide. That's it for tax credits. Let's move on now to talk about tax payments. So there are different types of tax payments. There is withholding, there are estimated payments, there are amounts applied from the prior year tax return, and there are refundable credits. So refundable credits, the part that is refundable, is actually considered a tax payment on the tax return. So we're not going to talk any more about those because we just covered those. Withholding. Withholding is going to come most often from a job, from a W-2. So you get your salary, they withhold tax every paycheck, get your W-2 at the end of the year, you have your amount of withholding. You also, though, could have withholding reported on a Form 1099. So especially a 1099-R, which is for retirement benefits, those will frequently have withholding. And other 1099s can also have withholding. Anytime you get a 1099, you just want to look and check to see whether or not there is withholding. Estimated payments. So sometimes you have income on which there is no withholding done. So for instance, self-employment income, not going to typically have withholding. You could have large capital gains that you had from selling some assets, not going to have withholding. So if you have those types of income or any income that you did not have withholding that is taxable, then you may want to make estimated payments. You make these on a Form 1040-ES. by making these payments, you can avoid penalties for underpayment and late payments. So the IRS wants you to be paying in as you earn your income. So all year long, they want you paying in. So when you have a job, it's pretty easy. You're getting your paycheck every month, they're withholding the amounts every month. So you are paying in as you go along. But if you don't have withholding, the way you pay in as you go is by making these estimated payments. And they are called quarterly estimated payments. Although when you look at the dates here, they're not exactly on the quarters. So the quarters on the calendar year would be end of March, end of June, end of September, and end of December. But these estimated payments are due on these dates, and you will want to know this for the exam. They are due April 15th, June 15th, September 15th, and January 15th. So the first payment is due on the same date that the tax return is due. So this just makes it easy for the taxpayer. They finish their tax return. That gives them a better idea of how much they need to pay in for their estimates, and so they can make their estimated payments on April 15th. The next payment is then due 2 months later on June 15th. The third payment is due 3 months after that on September 15th. And then the fourth payment is not due for 4 months until January 15th of the following year. So this allows you to go through all of the year, have a good idea of how much money you made, and so then you can make that final estimated payment on January 15th. Just like with a tax return deadline, if any of these dates fall on a weekend or a holiday, then the amount is due on the next business day. When do you need to make estimated payments? Well, if you have those amounts of income that we talked about without any withholding, and you expect to owe $1,000 or more. So if you look at all your income, subtract any withholding you did have, if you look at that and you expect that you are going to have a balance due of $1,000 or more, then you will want to make estimated payments, unless you meet one of the exceptions. So you need to make estimated payments if you're going to owe $1,000 or more, and you expect that your total withholding and refundable credits are going to be less than the smaller of these two things, 90% of the tax shown on this year's tax return or 100% of the tax shown on last year's tax return. So what are we talking about here? Well, if you're doing your estimate of your income for the year, you're going to look at last year's tax return and say, well, how much did I owe in tax on last year's tax return? Then you're going to look at what you anticipate your withholding to be this year and any amounts of refundable credits that you have. If the total of those two things, if your withholding and your refundable credits, if the total of that is going to equal at least as much as the amount of tax you owed on last year's tax return, then you do not have to make any estimated payments. Even if you expect that you're going to owe $1,000 or more, as long as you paid in at least 100% of the amount of tax that you owed last year, you're not going to have any penalties for underpayment. So you don't have to worry about making estimated payments. Or, same principle applies if when you add up all your withholding and all your refundable credits, it looks like those amounts are going to equal at least 90% of the tax that's going to be shown on this year's tax return, then you're not going to be subject to any penalties and you do not have to make any estimated payments. So you only make the estimates if you expect to owe $1,000 or more and you do not meet either of those two exceptions. The penalty for underpayment, again, if you underpay throughout the year, if you don't pay as you go, you don't pay as you earn the income during the year, at least quarterly or through your paycheck, then you're going to have interest and penalties if you don't meet those exceptions. In most cases, the IRS will actually compute those penalties for you and then send you a bill. However, you can compute them yourself using a Form 2210, and your tax software should be able to do that calculation for you. Let's look quickly at the 1040ES. So these are called payment vouchers. So if you pay these by the mail, you're actually going to cut these. You're going to send in the voucher with the payment. So you can see it has the basic information and the amount that you are paying. And it actually shows you right on the voucher when that voucher is due. These are the 2024 estimates. So these are the ones that would have been made all during 2024, with the final one made January 15th of 2025. So they all look exactly the same, just a different payment voucher number and a different due date. So you can send those in with a check. You can also make these payments electronically, so then you don't have to send in the form. Another form of payment can be an amount applied from a prior year return. So when you have a refund due, you can elect to either receive that amount as a refund, or you can apply that overpayment to next year's taxes, or you can do a combination of the two. You can get a refund of part of it and apply part of it. So if you're doing your tax return and you can already tell that, I'm going to need to make estimated payments for this year. So let's say you're doing your 2024 tax return in 2025. And you're saying, you know what, I'm going to need to make estimated payments for 2025. Instead of having the IRS send you a refund and then turning around and sending them a check for your estimated payment, you can just have them apply that refund to that estimated payment. So by doing this, you can eliminate or reduce the amount of that first quarterly estimated payment, or depending on the amount of the refund, you might be able to eliminate 2, 3, or even all 4 estimated payments. But it's an easier way of making the estimated payments than getting the refund and then turning around and writing a check. So that brings us down to the bottom part, finally, of our tax return. Now we get down to the amount due or the overpayment. If you have an amount due, that can be paid in various ways. You can have a direct debit from your bank account. You just supply your routing number, your bank account, and the IRS will take the money out. And you can just tell them when to take the money out. So you can just say, wait until April 15th, and they will take it out on April 15th, or you can pay it anytime before that or anytime after you file your tax return. You can also mail a check, just like we always used to do. You can pay online directly at irs.gov, and you can use a credit or debit card in order to do that. They will charge you a fee for that, but you can put it on a credit or debit card. You can also actually pay cash at an IRS taxpayer assistance center or at certain retail stores, but that is only for amounts up to $1,000. And there are other ways. You can always check the IRS website with all the changing technology and everything. They are always trying to make it easier and easier for you to pay them money. So there can be other ways that you can pay as well. If you made an overpayment, you've got a refund due, you've got several different options. You can have direct deposit. Again, give them your routing number, your bank account number. They will deposit that money directly into your account. That is generally going to be the fastest way to get your refund, and is what we do for most taxpayers. However, if you want, you can just receive a check in the mail. You can receive a prepaid debit card. Some taxpayers don't have a bank account, and so a prepaid debit card will work well for them. You can use some mobile payment apps. As we discussed, you can apply that overpayment to next year's taxes as an estimated payment, or you can split, have part of it refunded, have part of it applied to next year's taxes. There can, again, be other ways to do this, especially when it comes to the apps. IRS trying to keep up with technology, so you can check the irs.gov website for the latest information on that. One thing that did change for 2024 is you can no longer use your refund to purchase U.S. savings bonds. So they used to give you that option. Not many people took advantage of it anyway, but that is no longer an option as of tax year 2024. So that is the end of video 5, and we made it all the way through the tax return. So now what we need to do is we need to cover some more of the specialized types of topics, starting with retirement accounts and Social Security in our next video. So I will see you in video 6.